Happy Monday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Monday, February 24th, 2025. Hope everyone had a great weekend. So, as always, we'll start with our executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So, today's key macro question is: how will markets react as investors shift from speculating on what if to analyzing what is? Our answers are: this week, we will receive a lot of critical information that will help investors recalibrate where we are in the key macro cycles, which are growth, inflation, policy, both monetary and fiscal, profits, and liquidity. In our view, the most important this week, the events this week are on Wednesday, NVIDIA earnings because of the risk that it poses to the most crowded trade in the world, which is AI. Number two, the January PCE report on Friday because of the risk to the bond market that inflation misbehaves and the risk to the stock market that growth disappoints. And number three, the G20 meeting of finance leaders and central bank governors because of the potential forward guidance that we may receive. And one caveat there is Scott Bessent has already confirmed that he won't be attending, so a little bit less of a risk there, but certainly a risk with the world's most important finance ministers and central bank governors. Regarding broad market risks from NVIDIA earnings, which again we think are the most important catalyst this week, our risk management overlays are currently signaling the following for related exposures. So the Max 7 equal weight S&P 500 ratio is currently bullish from the perspective of our volatility adjusted momentum signal. The tech and communication services market cap S&P 500 market cap ratio is currently bullish from the perspective of its VAM signal. And then the software to semiconductor ratio, semiconductor software ratio rather, that's important, the order there is important, is currently bullish from the perspective of its VAM signal. We also provide our VAM signals and our probable range signals for each of the Max 7 components, but obviously that is anything that can help clients transact and make money in financial markets. It's obviously reserved specifically for our clients behind our paywall. So clients, obviously, you can check that out in today's leadoff morning note. So we'll refresh these signals a Thursday morning to help clients accurately assess the impact of NVIDIA earnings, again, on Wednesday after the close. Transition to our 42 macro dashboard. As always, we'll wrap up with a question from our community. This one's regarding yen strength. It says, hi, Darius. Do you see similar downside risk for equities comparing to late August if the current strength of the yen continues? Not really, no. So I think what happened in August, starting in July, and what happened in early August with respect to the yen carry trade on Rhine, it was sort of a two-pronged attack, if you will, upon asset markets. That, in my opinion, was the second part of the attack with respect to I want to say it was the July jobs report that was introduced in early August. That kind of caused investors to have a sort of significant increase in hard landing expectations because of how weak the July jobs report was in early August, and so that took it started accelerating the unwind of the yen carry trade that began a week prior to that with respect to, or not a week prior to that. I think it was a couple of days prior to that Wednesday, with respect to the BOJ's decision to hike interest rates. And so, the BOJ sort of learned its lesson, if you will, from that move, and which caused the fastest crash in Japanese stock market history in a couple of weeks after that. But they learned a lesson, and so they kind of slowed down the pace of policy normalization. With respect to the current setup, it's not our view that we're going to hit a data point that sort of significantly increases hard landing expectations in the U.S. economy. I don't know if it's actually, no, let me take that back. That we are starting to see historically elevated policy uncertainty really start to impact U.S. growth. We saw it last week in the ISM, not the ISM, the S&P Global's services sector PMI slowed to 49.7. We had the New York Fed services sector index slowed pretty sharply to minus 10.5. Obviously, anything below 50 on a PMI is contractionary. Anything below zero in that New York Fed service sector index is contractionary as well. So, those indicators are presaging a pretty sharp slowdown in the ISM services PMI when that's released on March 5th. So investors need to be aware that we are seeing this historically elevated policy uncertainty really impact the economy. We saw it last quarter as well. If you look at the Q4 GDP statistics, we had a gross fixed capital formation contracted minus 60 basis points. If you look at business investment, non-residential fixed investment contracted minus 2.2% in Q4. So, we're already seeing, an actual contraction in the areas of the economy that require more planning, more certainty as it relates to the policy outlook. So, this historically elevated policy uncertainty is going to be with us for a while. We know that they have to legislate President Trump's agenda with a very divided Republican Party in Congress, let alone a very divided Congress to begin with. And so ultimately, you're going to have a lot of kings demanding things within the Republican Party throughout this, this reconciliation process, which they haven't even figured out. Right, the Senate's on a two-track a plan, whereas the House is on a one-track plan. So we know historically elevated policy uncertainty is going to remain with us for a while. That's probably going to continue to have a depressing impact on growth. So could you see a lot of what these a repeat of what we saw kind of in July, August? Yes, I think the risk of that is lower. We don't think the Bank of Japan is going to be gung ho, full speed ahead into tightening as they were then. Nor do we, I think it's pretty clear that if we saw, I think it'd be pretty clear to investors that if we did see a significant slowdown in growth, it's probably not something that's going to push us into a hard landing, because again, they can just investors can write it off as being as being dictated by policy uncertainty, which ultimately resolve itself once we get more clarity on policy. So I think that the risk is there. It's just not, in my opinion, as high as it was in August. So we're wrapping up there. Darius Dale here presenting our macro minute for Monday, February 24th, 2025. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers. Oh, and by the way, I'll be on Schwab Network today. I want to say at 2 p.m. So come check us out on Schwab Network today at 2 p.m. Eastern, and we'll catch you back here tomorrow. Cheers.